Good morning and welcome to this Wednesday, July 1st, 2020 edition of Trading Places Live here at EarningsBeats.com. I'm Tom Boley, Chief Market Strategist at EarningsBeats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Before we get into the action from yesterday, I do want to just start off with the main page at EarningsBeats. A couple things I want to point out for those of you who are maybe new to EarningsBeats. We do have a free newsletter. Make sure you sign up if you're not already signed up. Monday, Wednesdays, and Fridays it gets published. Usually just a really brief article about relative strength, earnings, those types of things. But just fill in your name, email address, hit subscribe. No credit card required, completely free. You can unsubscribe at any time. The other thing I wanted to point out, and I tell you, this is something we're really proud about at EarningsBeats, but check out this model portfolio. We've now got, we keep track of these portfolios. We've been posting them and updating them, trying to update them every day. Sometimes maybe we miss a day or so, but take a look at the performance here. Model portfolio, we started this back on November 19th, 2018, so it's been less than 2 years. Actually just a little bit more than 1.5 years. We've been through a trade war, lots of fear about the trade war, cyclical bear market back at the end of 2018. That's when this was started, right before the S&P took a 20% dive in December of 2018. And then we just went through the pandemic where we had a 35% drop in the S&P 500 before rebounding. Model portfolio now in 19 months is up 100.74%. And this isn't just taking and throwing everything into one stock and hoping it works out. This is an equal weighted portfolio that gets updated every 90 days. So these are 10 stocks that come from our strong earnings chart list. This whole model portfolio concept was really started back in 2018 when members would ask me, hey, we've got 200, 300 stocks on the strong earnings chart list. What are your favorites? And so one day I said, hey, here are my 10 favorites. They're in 10 different industry groups. And the model portfolio was born. And so now we're into our 7th quarter, still in our 2nd year, 100.74% gain, while the S&P is up only 15%. And anyone who's been around the market for a long time knows that just simply outperforming the S&P 500 is not easy. But to do it in this fashion is unbelievable. I would have never thought in a million years that we could put together portfolios here at EarningsBeats that would produce this kind of outperformance over, what's now our 7th quarter. So in the previous 6 quarters, the model portfolio outperformed 5 of the 6. It didn't outperform one of the quarters, it actually underperformed. And you can see this quarter right now, it's absolutely smoking, up almost 20% this quarter, while the S&P is up just 6%. But the other portfolios, not bad performance here either. They haven't been around quite as long. The aggressive portfolio now is into its 2nd year, into its 5th quarter, but up 32% versus the S&P's 8%. So 4 times the return. This quarter, just kind of matching the S&P right now. Go down to income portfolio. This actually was a pretty good portfolio until the February quarter. And that was when the pandemic started. And unfortunately, we had a real estate company. There may have been one other defensive group in there, a little bit more defensive area. And those areas, even though it was a pandemic and a fearful period, you would think some of those defensive areas would do well, but those were the areas that got hit the hardest. And so anyway, the income portfolio took a pretty good hit last quarter, but it is starting to rebound. It's about even with the S&P this quarter, and it's down about 4 percentage points since we started it a little over a year ago. Our newest portfolio is the strong accumulation distribution portfolio, and that was started out of this pandemic. So we began to notice companies that were performing really well on a relative basis back in March and April. These are companies that while the overall market, everything was kind of gapping down at the open, these were companies that were coming back during the day, showing signs of accumulation. So we put all these stocks into a strong accumulation distribution chart list, And then back on May 19th, I picked what I thought were 10 of the best in 10 different industry groups. And right now they're outperforming the S&P by about 3.6 percentage points, up 9.67% this quarter versus the S&P's 6.07. So overall, I think the portfolios are doing great, but that was quite a milestone. I wanted to point that out. Model portfolio now up over 100% in 19 months with 2 cyclical bear markets in that time period, which is pretty impressive. All right, let's move on. Take a look at what happened in the market yesterday. We did see the Dow Jones Industrial Average up 217 points, S&P up 47, NASDAQ regaining some of its relative strength, rising 185 points and not far from closing at a new all-time high again. I mean, it was just a few days ago, we topped and then saw this weakness down to the 20-day moving average. Well, we got back 185 points yesterday, and the NASDAQ on the verge potentially of another breakout. Mid caps also up 1.3%, small caps up 1.4%. They lagged a little bit on a relative basis, but they did hold on to key price support, the moving averages, starting to turn higher. Same goes with the S&P 500 and the Dow. So I see nothing wrong technically, other than maybe the NASDAQ still a little bit overbought. We've got a negative divergence on the NASDAQ. But if you look at the other major indices, we're simply back to the center line on the PPO. So I think the market still looks like it's in pretty good shape to me. Energy got a big lift, went down, tested the recent price low, the moving averages starting to turn back up again. Of course, that breakout above 40, which I thought technically was significant, we ended up turning right back around and losing it. We had that island cluster reversal, came back down below the 40 level and trying to hold on to support. In a secular bull market, which is what I think we're in, I believe all 11 sectors are going to do well, including energy. I just think that the relative strength, until it begins to show relative strength, it's not going to be an area I'm going to focus on for my trading. So yes, it's probably going to move higher from here, but I would much rather be in technology, in healthcare, probably not so much in real estate. Materials not looking too bad. Certainly not as good as technology, but materials have not been too bad. I'm a little bit more concerned about materials because of the dollar. I think the dollar remains in an uptrend. And as long as that dollar remains in an uptrend, which I believe it has since 2011, materials and energy are facing headwinds. And so I'm not going to really be looking too much into those two groups. But anyhow, yesterday you can see these were the 5 groups that were leading. All 11 sectors finished in positive territory yesterday. All right, 10-year Treasury yield. We did get the June ADP employment report out this morning. It was disappointing actually for June. 2.37 million jobs versus 3.5 million expected. However, May was revised significantly higher. We reported last month, well, ADP reported last month that there was a negative number, minus 2.76 million jobs. And they revised that number to a positive 3.07 million jobs. That's almost a 6 million job revision. That's unfathomable. I don't know how you miss or how you need to go back and adjust by 6 million jobs. Obviously, you did something. I didn't look into it. I don't know why they had to make this revision, but 6 million job revision is, I can't even comprehend that. But anyhow, that I think more than makes up for the fact that we were a million short, a little over a million short on the June number. Later this morning, we've got June PMI manufacturing coming out. 49.6 is the expectation. May was 39.8. So we're looking for a significant improvement in the June PMI number. Same goes for the June ISM number. June ISM manufacturing expected to be 49.0. May was 43.1. And then finally, May construction spending will be out at 10 a.m. The estimate there is for a rise of 0.8%. And we are looking into that rear view mirror back into May, which is typical for a lot of the home construction reports that we see. All right, let's see. What else do we have here? Let's go back over to the 10-year Treasury yield here and just get an update. And you can see we are up 3.3 basis points today, back to 0.69 rounded trying to get back through these moving averages. This is good news for the financials. Yesterday in the daily market report, I wrote about the fact that the 10-year Treasury yield, I was looking at the banks. So I just wanted to pull this up in case you didn't see this. But the banks, you know, this is going back 10 years. So we're clearly in an uptrend. Then we had the big drop back in March. And now banks are trying to recover a little bit. They haven't recovered nearly as quickly as most of the rest of the economy. And I think it's, you know, for good reason. They got a couple of really major headwinds right now. One, interest rates remain extremely low. Biggest line item, or the biggest part of a bank's financial report, is their net interest margin. When rates are down and falling, that net interest margin gets squeezed, and banks are not going to perform as well. Not as well as some of the other companies that are going to benefit from these low interest rates. So that's part one of the bank issue. Part two is this pandemic is causing a lot of problems with small companies and mid-sized companies and some large companies, especially those that haven't been able to adapt to a work-from-home strategy or scenario. So you've got, you know, number one, you've got the yields being low, squeezing net interest margins, but then you've also got a lot of companies out there that borrow from banks that are running into financial difficulty. So the banks have to raise their loan losses. And I can tell you, having worked in public accounting and audited companies, specifically banks, this was my specialty. I actually audited a number of banks. When the Fed comes in, it's worse for the accounting people at a financial institution when the Feds come in than it is when the CPAs come in. The Feds are really, really strict. And so when they start seeing potential issues in the economy, they force banks to write down their loan portfolio. And so if the economy strengthens, I think we'll see a reversal of that maybe in the next 6 to 12 months, and that will help banks. But in the meantime, we've still got very low interest rates. So let's forget about the loan loss reserves for now. Let's just talk about interest and the impact this has on banks. So first of all, I highlighted this blue shaded area here back in the middle of 2012 through the end of 2013. That was a really strong period overall for the stock market. The S&P had a really strong period. Most everything in the market went higher. You can see banks also went higher. You can see that banks relative to the S&P 500 went higher. That's what this chart's telling us, this part of the chart. Look at what the 10-year Treasury yield did during this period. It was one of the most significant rallies. Now, we saw some other rallies in the 10-year Treasury yield, but the problem was that with this rally in the 10-year Treasury yield, the problem was the 2-year Treasury yield was rallying even more. So the spread between the two was going down. Notice in this blue shaded area, not only were interest rates going up, but that yield spread was going up. And this is really critical for banks. So when you get the yield spread rising, that can help banks. Now look at what's going on over here right now in the last, 6-8 months. We're actually seeing the yield spread moving up. So why are banks going down? Well, I think it gets back to the loan loss reserves. I think we have something other than just the net interest margin that we have to consider. And until that straightens out, until we know exactly how some of these companies are going to do. Remember, at EarningsBeats, we've got chart lists. We got a number of different chart lists, but we have a strong AD chart list, strong accumulation distribution chart list, but we also have a weak accumulation distribution chart list. And a lot of those weak AD chart list stocks are in areas like the airlines and the cruise lines and the hotels and the gambling stocks and so forth, recreational services, many of the REITs. But these are all companies that a lot of these companies are highly leveraged, and they've got a lot of bank debt. And so even though the spread is improving, part of the problem is, number one, we've got the yield, which overall has been falling. We really want to get both. You want to get the yield going up and the spread going up. And we also need to get past this economic period that we're in, which is a problem for now. So when you look down here at the bottom, I ran these two correlations. One compares the bank performance to the 10-year Treasury yield. So in other words, when the Treasury yield goes up, banks tend to go up. That's what this positive correlation tells us. And the green shaded area is above 0. So this is when they're moving in the same direction, banks and the 10-year Treasury yield. Down here, this is the banks, and also comparing the banks to the spread, the yield spread. And you can see for the most part, it's in positive territory. Now, when you look at banks and the 10-year Treasury yield right now, notice that we're near positive, 1. We're close to very, banks are going down, the 10-year Treasury yield's going down. So that's pretty close correlation. But the 10-year Treasury yield minus the 2-year Treasury yield, that yield spread's been going up, but the banks are going down. And that's resulted in the most significant inverse correlation that we've seen over the last 10 years. But I think the explanation there is the loan loss reserves, that banks, need a strong economy. They don't want a lot of foreclosures. They don't want to have to foreclose on these loans. And as a result of what we're seeing in the market right now, I think that's what's leading to this disconnect. So banks are just going to have a little bit of problem. So when I mentioned, just a second ago, 10-year Treasury yields up, which is good for banks, that's what I was talking about. The 10-year Treasury yield, this is one part of that equation. When the yields are rising, that tends to be good for banks. But we do still have this loan loss reserve that we've got to deal with. All right, it is July 1st, so we now have the first 6 months in the books. So I thought what I would do is show you the relative strength of our sectors year to date, and also do the same thing for the industry groups, so you can get a sense of what's been working. Now, you got a lot of folks out there still thinking that we've got this awful bear market, Great Depression coming. I think it's hogwash. I don't agree with any of it. Even in the midst of all the selling that we saw over the past few months, I still remained bullish. I still believed we were in a secular bull market, and I think this market has proven me to be correct. And when you look at the sector performance over the past 6 months, this does not look like a bear market to me. Wall Street's not dumb. Wall Street can see when things are heading down, when the market is going to head into a tailspin and we're going to be in trouble for 2 years. If that was the case, we would not be seeing technology, consumer discretionary, and communication services leading. These are 3 of the most aggressive sectors in the market. If we were into a bear market, these aggressive growth stocks would be getting hit, and getting hit hard. That is not the case. I do not see this composition of what's taking place in the first 6 months of the year. I cannot see the bearish argument in it. I really can't. I see low interest rates. I see these companies, many companies within these 3 industry groups, growing their earnings rapidly. And so I see much higher valuations coming for many of these companies. A lot of folks look at it and say, well, these companies, Tesla's over 1,000. I can't buy it now. Well, I believe it's going to be 2,000, and it might be a lot faster than you think. So if you don't like it at 1,000, you're going to hate it at 2,000. But again, just my opinion. I don't know for sure it's going up. Maybe it's 400 a year from now. Maybe I'm wrong. But I like it. And I think when you look at the relative strength of the industry groups, look at what's up on top. Number 1, automobiles. Why is automobiles leading? Well, I can tell you a good part of it is because of Tesla. Tesla's having a great year. Just broke out yesterday to an all-time high. Volumes confirming it. I think Tesla looks great. What else is leading? Broadline retail. You got Amazon, big part of that. But there are a lot of other broadline retailers, especially those that have a good presence online, that are doing extremely well in this environment and actually are taking share. People are still spending money. It's just that they're not going out physically into the stores to spend their money. They're sitting at home, socially distancing, trying to be smart from a healthcare perspective, but they're still spending money, but they're doing it online. So companies that already had their online presence there, they're set up beautifully for this. Wall Street knows it. This money was going into these groups back in March and April. I pointed this out back in March, April, when we established the accumulation distribution chart lists, strong versus weak, that there was this. I even wrote an article. I said, we have a raging bull market and a suffocating bear market at the exact same time. It just depends where you are in the market. Some of these areas were absolutely showing tremendous signs, and quickly in April, some of them even in March, but most of them, many of them in April, breaking out to all-time highs while the market was still 20% below its all-time high, maybe even 25% below. So the money was rotating. Wall Street saw it, was rotating. We saw what Wall Street was doing, where the money was going, and we've broken these groups down. But autos, broadline retail, both strong. Now here's your gold mining, mining shares. These are, these have performed well. I'm not a big fan. And I'm not a big fan. The reason they've performed well is because there's been so much fear in the market. Fear is a big driver into gold. I'm a secular bull market believer. So I believe market's going to go higher. I think as the market goes higher, the fear is coming down. And even though I think gold and or gold mining and mining shares, even though I believe they can go higher and they may go higher, I think they're going to underperform on a relative basis. And that's what's important to me. I want to be in the areas that are outperforming, not underperforming. But look at the rest of the groups here. Here's software, computer hardware, toys, specialty retailers, recreational products, specialty finance, home improvements, truckers, biotechs, internet, semiconductors, financial administration, business support services, medical supplies, so on and so forth. These are the groups. Here's their outperformance on a percentage basis. If you want to beat the S&P 500, you've got to be in groups and in stocks that are leading. This, to me, it's not rocket science. I like to follow what Wall Street's doing. Now, does that mean that I'm just going to blindly buy these stocks and hold them for the next 10 years? No. And that's why our portfolios adjust every 90 days. Because at some point, I don't know when it is, at some point, the dollar is probably going to weaken. It's going to break down. Energy and materials are going to start to lead. At that point, we're going to want to own some of those stocks in our portfolios. Not now, but at some point. But for now, we're going to stick with what's working. So that's why we're going to own stocks like Tesla. We're going to own stocks like Amazon. We're going to own stocks like DocuSign, Apple, and so forth. Peloton. These companies that have been doing so well in this pandemic. And I hear the biotechs. I'm kind of on record talking about the biotechs. I love the biotechs as we move forward. I think this is going to be a key area. I'm positioned fairly heavily into biotechs. I like the biotech area quite a bit. All right, let's keep moving on. So let's move on into earnings. FedEx came out with earnings, and they were blowout results. These were shocking considering the way that FedEx has been trading. Let's look at their chart first. You've got the delivery services, which has been rising. And if you look at the relative strength, delivery services now for about the last 6 weeks, this group has been outperforming the S&P. FedEx has been outperforming the S&P over this period. Relative to its delivery services peers, though, it's got higher low, but it's mostly sideways, maybe a little bit of a uptrend in play. But I had my doubts. I wasn't sure what was going to happen here with this report coming out. It would have been one that I would have been very afraid to hold into earnings. But at this point, I wish I had held it into earnings because FedEx just blew the doors off its earnings. Market was expecting $1.42. FedEx posted $2.53. $2.53 versus $1.42. That is a blowout. They topped the top line expectations, revenue expectations, and we'll take a quick look at the pre-market action, but it's up 12%. So it is looking to open right now. We got another 6 minutes, but right now it's looking to open up $17 to $157. I think it's probably going to run up eventually. I don't know if it'll run up this morning, but I think it's going to go up and challenge that 162, 163 level. When you've got a low interest rate environment and you've got a company that comes in and beats earnings like this, you've got to adjust your business valuation model going forward. Unless you believe that this is just a 1 quarter thing for FedEx, if this is adjusting their earnings going forward, then I think their valuation is completely out of whack. This is a company that may simply take off and break out above those prior highs. Now, I don't like chasing on a gap up at 17 because while everybody's buying, market makers are on the other side. But if this stock comes back down and breaks back into the 140s, I think that would be an interesting development, especially if it were to get all the way back down to 140. I don't believe that's going to happen. I think we have new information here that, in my opinion, completely changes the valuation of the company. But if we were to pull back after the open, get back close to that 149, 150 level, that might be interesting this morning. We'll see what happens with FedEx. General Mills reported. They beat on their bottom line, $1.10 versus $1.06. Stock down 1.78%, about $1. I think you got a nice uptrend, sideways consolidation. I would just watch $58.50, $59. Right now we're 60.5. I think we're fine. STZ, Constellation Brands, up 4.6%. They also beat, and they beat by a pretty good margin, $2.30 versus $2.03. So got a little bit higher lows here, a little bit higher highs here. I definitely see a trend to the upside. Looks like we're going to open around 183. 187 or so is going to be a key area of resistance we're going to need to break above on a closing basis. I don't know what that is, 187, 188, something like that. But until we break above that, I think we're probably just in this trading range. But I do like the numbers that came out here, and we're getting a nice reaction there. And now let me show you one that didn't react so well. This is UniFirst Corp. And I'm going to pull the chart up in just a minute, but down 7.6%, $13. And when you look at this chart, this is really important. If I was going to think about holding a stock into earnings, I need to know that it's being respected as one of the best among its peers. If you look at UNF, here it is versus the business support services. This stock has been downtrending versus its peers for the last 8 months, and it's near a 52-week relative low, while it's been in a very strong group. Look at the business support services going up. So would I hold a stock like UNF? No chance. You might look at the chart and say, well, it's in an uptrend. Yeah, it's in an uptrend, but it's not keeping up with its peers. So I'd be a little concerned. So one thing you can do, let's say you look at the stock and you say, hey, business support services looks good. I want to get in the group, but I don't like the stock. What do I do? Well, if you go over here to the scans, this is pretty cool what stock charts, what you can do. Pick new scan. I always like to make sure stocks are liquid, so I'm going to change that to 200,000. Maybe 50-day moving average is greater than 200,000. You're going with stocks, but over here under sectors and industry groups, you can go in, and this is under the industrial group, business support services. You can click this and just add that industry group to your scan and then run the scan. I mean, check syntax, but I know this one's fine. But here, look at the scan. Now I'm going to sort it by scooter score. So now I'm going to get top relative strength stocks. Look at CoreLogic. I mean, this one actually I talked about during one of our shows, Trading Places Live. I think it was last week when it was making this breakout right before the close. I said, hey, I got to go take a look at this one, CLGX. Had a couple members write to me and say that they had bought this stock. But look at that gap up. I think that there was an announcement that the stock was maybe going to be acquired. I think somebody was looking at the stock, but maybe at $65 or $67 a share or something. I'm not sure. But big move to the upside after that breakout. Let's see, another one. Oh, let's go back here. Another one I really like on this list is ZTO Express. Been pulling back, but this has been a leader, clearly in an uptrend. These are types of stocks that I would want to be in this space. How about Verisk? Watch for this breakout on Verisk. It struggled right here about 170 to 172, 173. Closed at 170 yesterday. Volume started to pick up. Watch to see if we get a breakout here. This is how I would treat, when I see a good group. I want to get the leaders. I want to get the stocks that are showing relative strength. I don't want stocks like UNF. That is among the worst stocks in the group. Leading stocks in leading industry groups. That's how you're going to outperform the S&P 500. All right, upgrades, downgrades. I just wanted to mention today, Caterpillar getting upgraded today. Stock pulled all the way back, put in a reversing candle near this gap support. Wouldn't be surprised to see maybe a move to the upside. Look for sideways consolidation. So I'm going to look for a trading range here, maybe 117.5 up to maybe 140. But I wouldn't be surprised to see Caterpillar make another run. It's not one of the leaders in the market. It's not something I would own. I think there are better stocks out there, but I do like this pattern. I think with the upgrade, we may see a little bit more upside here. Square got upgraded today. And we did just open with the market, but Square got upgraded. You can see it breaking out. Been in a beautiful uptrend. And one of the groups I mentioned in that 6-month industry group when I was looking at the leaders this year, financial administration stocks. That's where Square belongs. And you can see this has been one of the leaders. Certainly off that March low, it's been a leader. Square looks good. As far as downgrades, one stock that was downgraded was Bloomin' Brands, BLMN. Broke back down below its 20. It's below its 20 and its 50 until it clears back up above that 20 and 50. I'd be concerned because as you look at the relative strength and relative to the S&P, yeah, it's up a little bit off the very bottom, but this is rolling over and we're back at about a 2.5 month low, relative low on Bloomin' Brands. So I think you got to be careful. Stock down just a little bit here in early action. All right, let's wrap this thing up. 3 you must see. I'm going to start with a stock. I actually traded this stock, and it's on our, I want to say it's on our short squeeze chart list. And so I had traded it. I think it was one of these days when it had come back up above. I didn't get into it until it was around 6, I think. So I think it was, I think the heavy volume day here, I may have looked at the short squeeze chart list and decided to buy it. But when it got up to the prior high, I just took the money. Not, I didn't know if we were going to get that breakout or not. But I didn't see this until earlier this morning that the stock yesterday had moved down 48%. Just absolutely crazy. I'm going to update it and see what it's doing today here. Well, it did gap up a little bit today, but it's still rough. And look at that false breakout. Now, if you didn't know anything going on with this stock, if I owned this stock and I saw this stock break out to 7.5 above this resistance area, which I think was around 670 or so, and it came all the way back down and closed below that breakout level, that is a warning sign to me. I don't like to see false breakouts. A lot of times that's used to distribute shares, just like these move down with these long tails to the downside many times is a way to accumulate shares. The long tails to the top, shooting star doji like that, is not a good sign at all. Now, I would have not necessarily been looking for a 48% drop, but I would not have been excited about holding a stock long when it does that. The other point I wanted to make here with the stock is it is a very small biotech stock. And I've talked a lot. These are probably the riskiest stocks you can buy. When I said I like biotech, doesn't mean that I would go out and put large sums into a small biotech. Keep in mind, many of these companies are developing one product. And if that product goes through an unsuccessful FDA test, trial, which is exactly what happened to Zynerba, ZYNE. They came out, I think they had a cannabis-related drug that was testing a rare genetic disorder or something, and the stock failed. It failed to meet, the different criteria that it was looking for, and the company lost 50% of its market value overnight just on a test, not an earnings report, just a test. So if you're going to trade the biotechs, personally, I would stick with either the larger cap biotechs that generally have a much more, much larger product pipeline where one stock isn't going to take it down 50% for the most part. Or maybe even do an ETF, IBB. I own IBB just because I can spread my money across a number of large cap biotechs, and I like most of those large cap biotechs. You can go to Yahoo and get a breakdown on an ETF. It'll tell you, the holdings in an ETF. So you go to finance.yahoo.com and you can get a breakdown. But I like a lot of the stocks, technically and fundamentally, that make up a good portion of the IBB. So that's why, I kind of like trading that. Actually, I'm just holding on to it right now. But anyway, that was Zyne. That's one of the 3 you must see. I'm going to get through these other 2 a little quicker here because it is well past 9:30. Vulcan Materials, you can see the gap up and then we pulled all the way back. See how we held that gap support level and now starting to turn back up? This is a stock, if we look at the relative strength, and it hasn't been a great performer here versus its peers. It's starting to move up, and even versus its peers, it's starting to move up here over the last 30, 40 days. Same versus the S&P 500. The group, though, is starting to show some strength. So this gap up on heavy volume, I'm thinking we're just coming down, filling this gap. I think this one's got a good shot to get back to 125. And then if it breaks out, you may see this leadership begin to tick up on VMC. So I think this one is worth watching. And then finally, I'm going to pull up DLTR, Dollar Tree, specialty retailers. That's a group that was pretty high on the list of industry groups for 2020. And there is the group on an absolute chart breaking out. Here it is relative to the S&P going higher. Now, Dollar Tree is starting to show relative strength here. See this big move up back at the end of May? That coincided with the heavy volume gap up with earnings. Since then, we went all the way back, filled the gap, actually gapped below the gap support level, but printed a reversing candle. That is a piercing candle off of a downtrend. And I think we're moving back up on DLTR. So I actually like this stock. I think not only do we get up to the 100 area, but I think we're going to break out. I like the group, and I think this stock is starting to become more of a leader. So, if I was getting in, maybe get into a portion. If it goes back into the 86, 87, 88 range, maybe you could add a position, to fill out a position. But I believe this is going to be a stock that breaks out. I don't own the stock. I don't own any of the stocks that I've talked about today, except IBB. All right, I think that is it. So we're going to wrap up. I'll go ahead and just give you a quick update on the market. Futures were all over the place. We have turned positive now, though. Very good action here. The Dow leading on a relative basis. NASDAQ actually faltering a little bit on a relative basis after leading yesterday. Look at it, FedEx. I think I mentioned that 162, 163 level. I wouldn't be surprised. There's definitely a revaluation that's going to be taking place on FedEx based on those numbers, in my opinion. So we'll want to certainly keep an eye on that. All right, that's it for today. Everybody have a great day. Hopefully the second half of 2020 will be better than the first half. Let's hope so, right? Anyhow, everybody have a great day, and I'll be back tomorrow over at Stock Charts. Happy trading, everybody.